Hello and welcome to the weekly chart review. I'm Xenia Taubina, the owner of XT Financial Services. And in this video, we're going to review the 6 markets and their daily charts, the 6 markets that I follow most closely. Let's begin with the S&P 500. As of last weekend, with S&P being over here, I saw it as being a near-term bullish. And that played out in full on Monday. So we got a rally to test the 5783 resistance and topping at the resistance. It bested it by 3 points, but basically got rejected at resistance. And action began to develop bearishly. For those of you who are in the daily service, you know that I saw it as heading lower. The question was it lower constructively, or was it lower that eventually would break the March low? So by the end of the week, we have an answer to that question. And as it stands now, for as long as 5670, so that's this red line over here with the green triangle, for as long as that's not exceeded, odds favor the March low to be broken and for a lower low to develop. Now, the way I'm viewing this is for as long as it can hold 5398, so that's the bottom of this green box over here, it should be forming at least a short-term bottom in that zone. So what do we expect after that? And that's assuming that 5398 held. At a minimum, I'm expecting a bounce towards last week's high. So we'll recalibrate it once we know where exactly it bottomed. And the retrace fibs will be our guide. So this is the retrace fibs based on the decline so far. But obviously, if lower lows will be made, those retrace fibs will need to be adjusted. And vicinity of last week's high also happens to roughly coincide with the 200-day moving average. That's this dark blue line over here. Retest of that is likely for as long as 5398 held. There is potential for S&P to then complete all of the decline. And this stems, I will spare you the Elliott wave speak, but this top over here was ambiguously shaped. So potential is that real top of the rally happened in December, and this was part of the corrective bounce, even though it made a slightly higher high, and that this green box may be completing all of the decline. Now, how do we know? We're not going to know at the time of bottoming. We will likely have a better understanding of the odds once this bounce to the vicinity of last week's high happens. And depending on how it proceeds, we'll reassess the odds of all of the correction having completed here or only part of the correction. So viewing this as near-term bearish and ideally to break the March low, but then this green box is, to me, is a buy box. So I see this as a place to position from. And then depending on how it proceeds, we'll have to decide whether to hold it for higher highs or say thank you and bail in the vicinity of last week's high. Okay, moving on to Russell 2000. Russell 2000 is in a different stance. Here we have the rally off of the 2023 low that likely completed. And the similarity here is that last week it also extended higher, also topped at its resistance. Resistance per last week's analysis was 2112. It topped at 2110 and produced enough of a decline to ideally see a lower low. That perspective remains for as long as 2057, that's this red line over here with the triangle, for as long as that's not breached. So for as long as it's below it, we should make a lower low. Based on the micro pattern, odds of it holding 1935 are quite good. So for as long as it can hold this box, further upside has good odds of developing. And then we'll have to see whether it's able to clear last week's high to suggest that this was all of the decline, or if it just does a bounce to the vicinity of last week's high, but without breaching it and proceeds lower. So because of the more bearish stance, bigger picture, I would be more cautious on any longs that I would attempt or may attempt in Russell than in the S&P or NASDAQ. But potential for a swing trade, let's put it that way, does exist, although Russell does have more to prove on the upside. Okay, now moving on to NASDAQ, which for some reason I do not see. Here it is. Okay. NASDAQ has a stance that's very similar to the S&P 500. Big picture, I didn't mention it in the S&P, but for as long as the red line over here is not breached, and that is the 16,973. And then in S&P, I should add that that line is at 49.53. Stance does favor higher after the correction completes. So the question here is whether correction will complete with this lower low that hopefully will develop next week, or if it's going to be more protracted. So let's walk through this. For as long as NASDAQ does not exceed 19,740, so that's this red line over here with the green triangle, a lower low is favored. And for as long as this lower low is holding 18,400, so that's this red line, it will be favored to be followed by a larger bounce at a minimum to the vicinity of last week's high, and potentially all of the decline bottoming there. As is the case with the S&P, we will not, we're unlikely to know which of the scenarios is playing out at the time of bottoming. So we don't need to know which scenario is playing out at the time of bottoming. All we need to know is, do we have a bottoming pattern in the target box? And that action we follow closely in the daily service. So the intraday, the structure of the decline, we analyze very closely there. And if we get bottoming in the target box, it's worth attempting a long for at least a bounce towards last week's high. And then depending on how that bounce proceeds, we reassess the odds of all of the decline having bottomed or not. And that is practically how I prefer to approach it, instead of having mind-numbing arguments about whether that's all of the decline or not. I don't pretend to know the future. I merely read the charts and look for opportunities to take a position when clean signs of bottoming or topping are developing, or when clean breakdown happens, like we did on Friday. Okay, moving on past equities and to TLT. So the TLT chart hasn't budged much since last week, but let's just recap big picture for those who may not have seen last week's video. So I was viewing it bullishly off of the Jan low. It provided the minimum bounce. So my bullish perspective ended right around here. And those of you in the daily and weekly service know how I was positioned. And at this point, it's really in the decision zone. So on the downside, the key level is 86.86. That's this red line over here with the red triangle. So for as long as that's holding, some further upside remains reasonably probable. And the development that we have last week is that we did get downside continuation and an attempt to bottom and a meaningful gap up off of last week's bottom. So really, I would say that for as long as last week's low of 88.63 is holding, so that's this right here. So for as long as that's holding, it has potential for further upside. And to make further upside likely, it needs to get over 92 24. So that's this line over here was the green triangle. So triangles on my chart highlight the levels where odds shift substantially. So if it can get above it, and with the little gap up that we got on Friday, well, not so little actually, the gap up that we got on Friday, odds are reasonably good that it will hold last week's low and proceed higher. It has a path potentially as high as here. But before we really aim for this target above the 2024 high, we're going to need to get over the resistance at 94.85, so over here. So some upside seems to have good odds for as long as last week's low is holding. If that breaks, we're back to uncertain territory and turning bearish below 86.86. Now on the downside, if 86.86 breaks, the January low will be favored to break. And with that, will open up potential for substantial downside continuation. For that potential to really be viewed as likely, it needs to have, for starters, a sustained break of the 2023 low, which was 82.42, and downside continuation below 77.50. So that, if it can do this, it will open up a path to as low as 64 to 69. So still yet to be determined, but the little gap up seen last week does shift odds slightly in favor of some further upside off of the Jan low. Okay, moving on to gold. Gold. Here it is. Okay, so those of you who have seen my work over the preceding months, know that the ideal target zone that I was watching for gold topped at 285. And with the little extension higher, as of last week, we still favored a little bit higher to potentially then stage a top. We got that extension higher towards 285. So now we are at that really ideal topping point in gold. So I view gold, while obviously nothing is bearish, bearish has developed in the chart. So we're making all-time highs, but it has completed, according to my work, the high probability portion of the rally, at the very least of the rally off of the November low, and potentially even completed a larger degree advance. So to me, odds of a turn here are quite high. And earliest indication of a top will require a break of this red line. So that is 276.59 with a stronger indication below 261.25. So that's the second red line. And at that time, we'll have to see how the decline progresses and how likely it is that it will break 234.24. So this is really the long-term support. So at a minimum, a pullback to the really to basically below this prior swing high, which is 258. So pullback to this zone looks likely. Beyond that, we'll have to reassess how it got there and how likely it is that this support will hold or not hold. So a zone where I think one is would be well served to position defensively, but so far nothing bearish has developed yet. Okay, moving on to the last chart, which is GDX. GDX is in a stance that can be viewed as topping. However, this extension here is kind of steep, so it's a bit uncertain. So, but then I want to draw the parallel between this extension also, which also looked like at this time did not look like topping. And then yet this is what followed. So I think for the way I'm looking at this is for as long as 49.25, and that is this red line with the green triangle. for as long as it's below here. And ideally, it would be in the lower portion of this target box. Potential for topping does exist, and potential for a long-term top exists. So what we would need to see to begin to favor that is first and foremost a break of this first support with the red triangle, which is at 43.84. So if that completes, if this breaks, it tells me that this portion off of the late February low off of 38.58 completed. And then the break of this low, the 38.58, would be a stronger indication of a top. Ultimate support is at 33.42. So depending on how the reversal here happens, would have to reassess how likely it is that all of the rally completed or that it's going to subdivide from this zone with another extension higher. Now, what will tell me that I'm wrong is if it can rally over 49.25, it will suggest acceleration up. So in this scenario, it will then likely to proceed to 54.06 to 59.71. So that's the zone over here, and then proceed higher from there. So consolidate after that and then proceed higher. So really above 49.25, I would have to say that, okay, odds have changed. And the way I'm viewing this is the defensive positioning is warranted for as long as it's below here, but prompt repositioning will be required if 49.25 breaks. To me, that's a well-defined risk zone, and I'm viewing it as bearish for as long as we're below this line. So that's it for this week. Thank you for joining.